Coming up, has Australia reached peak interest rates, the market reaction, and a credit rating downgrade for the US? That's next. Your daily 10-minute business and finance news wrap for this Wednesday, the 2nd of August 2023. Later on Market Day, we'll speak with Adam Dawes from Shaw and Partners on the day's market action. But first to Westpac, which, along with ANZ and the Commonwealth Bank, economists there are now forecasting 4.1% as the peak in interest rates. That's where we are right now, and it follows the RBA's meeting yesterday. For more, I spoke with Westpac's senior economist, Matthew Hassan. Matt, so you've reduced your call in peak rates to 4.1%. A number of other economists have done the same. What exactly was in the RBA statement yesterday that made you change your mind?
Well, there were several things, really. So firstly, the decision itself and some of the shifts in the guidance in the decision statement made it clear that there's now quite a high hurdle on further interest rate increases. In particular, we saw the closing lines of the decision statement mentioning that further adjustments would depend on the evolution of the assessment rather than inflation and growth in conditions. So, I think that coupled with some of the other commentary throughout the release, made it look pretty clearly that the RBA is more confident about achieving its growth and inflation targets. The decision statement also was notable for what it didn't say. The RBA could have taken a more hawkish assessment of the June quarter CPI, for example, that some of the service components were less promising. It could have signalled more unease about the continued strength in the labour market, and perhaps even unease about needing to be at 2.5%, the midpoint of the 2 to 3% range by the out year in its forecast horizon. But it didn't signal any of those things. And so it's telling us now that the case for further tightening from here needs to be pretty rock solid, and it needs to be a balance of risks assessment to get them over the line. And from where we sit today, it just doesn't look like we're going to get any big adjustments to the RBA's expectation between now and September. And beyond September, I think it gets more tricky because we'll get more clear signs that the economy is slowing and that inflation is tracking back to its targets. So it's a mixture of the decision itself, what the RBA decision statement didn't say, how the decision is being framed, and just the timeline from here. Looks like we are at the end of this tightening cycle and in for a long pause now.
The inflation commentary is quite interesting, even though it's saying that inflation targets are likely to be met, I guess, I think somewhere up to 2025, right? Still, the RBA has been banging on about how important inflation is, how it's a scourge to the economy, how even at 6%, it's still too high. In the US, annual inflation is at 3%, yet the central bank there lifted interest rates. What's your take on that?
Well, I think firstly we need to understand that the US story is slightly different to here. The headline measure in the US is a monthly measure. It has all the sort of monthly volatility that goes with it. And some of the detail around inflation in the most recent updates in the US has been less promising. Also, policy has a different sort of timeline or profile that it has in Australia. If we look at US households, for example, with mortgages, 95% haven't seen any change in their interest rate settings, whereas here we're obviously copying the variable rate increases immediately. So I think, firstly, bear that in mind. It's a different circumstance in the US. I think here we are seeing a similar sort of easing in inflationary pressures. It's still the number one priority for the RBA to return inflation to target, and I think that's still very clear. What we're seeing now is more around the RBA trying to calibrate where policy needs to be. How restrictive do they need to be with interest rate settings in order to achieve that return to target over time?
So is it really a matter of the RBA waiting to see what will happen as opposed to it potentially seeing something sinister out there in the economy?
Yeah, absolutely. I think its central cases, its base case is starting to come through in terms of the way growth and labour market inflation numbers are unfolding. It's going to look to continue to confirm it. It's getting more confident about achieving that target. It's not particularly overly concerned about the growth environment. It's still mainly focused on the inflation outlook. I think once we get, maybe 2/3, 3/4 of the way back to that inflation target, then they can start to pivot and show a little bit more concern for what the growth side of things is doing. It's too early to declare mission accomplished on inflation, way too early, and it's still going to be some way before we get close to that.
So what are the risks to a rate rise?
Well, look, you can always get something out of left field. So, there are some really important aspects of the economy that the RBA is still looking for a turn on. So labour markets, for example, we still have 3.6% unemployment rate. It hasn't really turned. They need to see some more slack emerging in the labour market to confirm the medium-term profile. They're also very concerned about unit labour costs, so the low productivity growth environment. So we'll get updates around wages in late August, and then the productivity and unit labour cost story just after the September policy meeting. Any one of those could throw a spanner in the works if we get signs of a stronger domestically driven, labour market driven inflation. But as I said, the hurdle for action is going to be pretty high. Even if we were to see that, we've still got restrictive policy settings that are working to restrain demand, and the RBA will have some comfort that that will flow through eventually to labour markets and to some of these domestic inflationary pressures. Meanwhile, all the goods sector inflation surge that really drove the initial lift is unwinding. We're seeing a pretty clear disinflation coming through, and that's going to help bring inflation down in the first instance, but also go a long way towards anchoring expectations for low inflation at low levels. So, there's a number of things that might get them moving again if they are worried that the labour market was, say, tightening further rather than easing. If the wage growth story was coming through well above expectations, this is not our view, but if it was to happen that way, or if productivity growth was looking like a much more persistent problem that was not just seeing unit labour costs rise, but more persistent services inflation. So those next few CPI reads are still going to be very important. If there was something that was showing a pattern that would point to more persistent inflation, or perhaps inflation coming down but staying stuck in the 4 to 5% range, then that might get them moving again on rates. But it's hard to see all those preconditions lining up nicely. I think what those sorts of developments are more likely to do from our point of view is restrict them on any interest rate easing next year.
So is a simple way just to explain why the RBA is potentially not going to be lifting interest rates anymore is because its previous 12 increases are doing its job?
Absolutely. Yeah, that's exactly the takeout. So they think they're got policy at the right setting now to achieve the sort of slowdown that will help bring inflation back to target over the medium to longer term. They're taking this balance of risks approach because they know there's some things that could sideswipe us along the way, and expectations for inflation could prove to be more troubling. Labour markets could prove to be more troubling. But the big picture here is that they're seeing interest rate rises having a clear effect, and I think where they've got policy to at the moment is about right for achieving a low inflation.
Final two questions then. If the base case is now we're already at the peak and we'll see an extended period on hold, is it too early to be talking about rate cuts? And if not, when could we see it?
It is too early to be talking about rate cuts. Really, the RBA needs to have complete confidence that inflation is back in the bag, and they're tracking back to that anchored 2 to 3% level for inflation over the medium term. That's their primary focus now, and they're going to be very unlikely to give any signals that they have that level of confidence until underlying inflation tracks back towards those levels, and some of the other things they're looking for are softening in labour markets and a clear sort of topping out of wage growth, for example, before they'll be prepared to say that. And they don't want people rushing off with an expectation that we're going to get rate cuts anytime soon. On our view, though, by the time we roll through to around the middle of next year, we'll have much clearer signs that inflation is back under control, and we'll have enough evidence around a weaker economy that the RBA will start to move its language and talk about the need to provide additional support for a slow-growing economy. And we think there will be rate cuts in the back end of next year. But for now, they'll be very careful with their language to prevent anyone from running away and thinking that we're about to get a series of interest rate cuts in the next few months.
Hassan there from Westpac.
Now, Market Day on the SBS On The Money podcast.
Weaker day for the Australian share market today. The S&P ASX 200 down 1.3%, 7,354. The Australian dollar has taken a serious tumble over the past 24 hours as well. Sometime yesterday, 66.5 is where we were. The market now 65.6 US cents. For more, I spoke with Adam Dawes from Shaw and Partners. Adam, a number of economists have changed their forecast over the past 24 hours for a lower peak in interest rates at the current rate of 4.1%. But what's the market thinking?
Look, certainly I do think that the RBA has entered a new phase. Clearly that their focus has been predominantly on inflation, but now it's really sort of changing that or combating inflation. Now it's changed to monitoring the data and allowing household businesses to adjust to the reality of increased costs and to react accordingly. With economists also changing their tune, now they're calling this the end of the hiking of the rate cycle. But I don't think so, Ricardo. I think we still might see another 25 or 50 basis points by the end of this year.
So given that, what does all of it mean for where the share market's going now?
Yeah, it certainly looks like that the market has taken a lot of that in its stride. We've seen as interest rates are increasing, the market has also been increasing. So they're looking forward, looking 6 months, 12 months in advance. So I think that we can see the top of the hill of interest rates, and potentially that's a real positive for our market. But only time will tell. Labour market needs to happen. Job numbers need to, stabilise. These are the kind of things that we need to make sure that the market is on a level footing and moving higher going forward.
There's no doubt there are still some international challenges coming through. China is still struggling with its economic reopening. And one of the big stories of the day, Fitch, the global ratings agency, downgraded the US credit rating from AAA to AA+. How significant is that?
Look, following Standard & Poor's move to cut the US AAA rating to AA, you're absolutely right. Despite futures and currency falling off the back of that news, however, many expect that impact to be limited, and I expect that certainly to be limited. Fitch also flagged that this move is a possibility prior to negotiation of increasing the US debt ceiling. But really, at the end of the day, we knew all of this data was coming out, so it's quite timing-wise, it's quite interesting to see that they've actually started to downgrade now, versus this data was already out 6 months ago. So it's not likely to materially affect the market over the long term for investment strategies, but it certainly is going to put a bit of a dampener on the US economy going forward.
Looking at the moves today on the share market, what moved the market and why?
Yeah, so real estate continues to get hit on the back of negative news from office and real estate and infrastructure. Basically, consumer spending seems to be big on travel at the moment. We're seeing a lot of these travels. So retail travel has certainly finished, but the corporate side of travel is moving very well. Corporate travel, the stock corporate travel is looking quite good at the moment. So there's some bright spots in the pretty murky waters of the market at the moment.
Adam Dawes there from Shaw and Partners.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.